Hello. My name is Martin. This TDFA Teach the Teacher assignment week 3. Um, the topic of this week is financial ratios. I'm going to explain how to calculate financial ratios, how they help investors make informed decisions, and a couple of examples how to actually do it. So, by definition, financial ratios are different analyses. They compare financial statement data to evaluate companies' performance. Most of the data is taken from the balance sheet, income statement, or cash flow statement. And there are five main categories of financial ratios. Those are profitability ratios. Profitability ratios generally measure how well a company generates profit based on its sales. So, for example, we can calculate gross margin by dividing gross margin by company sales. Then there are liquidity ratios. So liquidity ratios measure how well a company can pay its short-term term obligations. There is current ratio, which is current assets divided by current liabilities, and there is a cash ratio, cash plus different equivalents divided by current liabilities. Then one of the main ones is also leverage ratio. Leverage ratio measures how well a company can operate with its debt. It's basically total debt divided by total assets. Also, there is return on capital ratios. That's self-explanatory. Return on equity is net income divided by total equity, and different types of dividend policy ratios. And so um, those different ratios basically help investors um, assess companies' profitability, liquidity, efficiency, and solvency. It's basically how to measure a company's overall health, and those ratios also help investors make decisions if they should buy a certain stock, hold it, or it is time to sell it. Also, it measures if the company is overpriced on or undervalued based on the market price. And ratios are the most useful when compared over time or against peers. That means if the company operates in the same industry, does pretty much the same thing as the other company, you can compare their ratios together to determine which company is doing better financially. Then I'm going to explain more deeply how to calculate P/E ratio. P/E stands for price per earnings ratio. It basically shows how much investors are willing to pay for each dollar of the company's earnings. And to calculate this, you can see a formula here on the screen. It's share price of the company divided by EPS, which stands for earnings per share. And it's important to know that first you have to calculate EPS, and the formula to do it is income minus preferred dividends divided by weighted average shares outstanding. And then you're able to calculate P/E ratio. And let's take this example. So if the stock price is 100 euros and earnings per share are 5, then you divide 100 by 5, which equals 20. And that basically means that investors pay 20 euros for every dollar or euro of their earnings. Then the second market ratio. It's price to book ratio. It's the second most common market ratio here, and there's a formula to calculate it. It's market capitalization divided by book value of equity, uh, whereas book value represents assets minus liabilities, and it derives from the balance sheet of the company publicly presented. So in this example, you can see if the company has a share price of 60 euros and book value per share calculated as 30, then it equals 2. And that basically means that investors value the company as twice as its market value. And so investors mostly use the price to book ratio to identify undervalued stocks or to compare companies within the same industry as I described earlier. Um, it's very easy to calculate, and you can take two pretty similar companies, and P&B ratio can determine which company is doing better on the share price of their stock. So, why ratios actually matter? For investors, it matters because financial ratios can help investors understand and compare different companies easily using financial formulas, which is easily done in Excel or other things like Power BI. And it can show investors they can identify undervalued opportunities for investment so they can make more informed decisions if they should buy, hold, or sell a certain stock. And you can also better understand market expectations and overall make better investment decisions. So that's it for today. Thank you very much. Goodbye.